right, we're live, and welcome to the OFL deep dive in AutoPlot. All right, so what is AutoPlot? As many of you know, it's a collection of studies. It's not just one single study. And basically the idea is to automate mapping out important areas of MGI as well as structural reference points. This helps you gain contextual awareness, automate drawing, all the reference points that you may draw today, and help create a non-discretionary way at looking at things such as balance areas and some of the MGI that's printed. So what's included in AutoPlot are single prints, RTH gaps, poor high, poor low, which we'll just refer to as poor references, balance areas, leg-to-leg profiles, which we have a nice update coming on, and the daily, weekly, monthly MGI. At the end of this webinar, we're also going to announce the winners of our March Apex contest. All right, so AutoPlot single prints. So single prints is a concept from Market Profile, and that's basically when the body of a 30-minute period does not have overlapping wicks from prior periods. This prints after the initial balance is set, so you can have single prints and B periods. So C period can open up with B period singles, and then we map those out throughout the rest of the session. The zones from single prints will automatically reduce in size, as you can see in this GIF here, and they'll be removed once they're traded through completely. You can also set the threshold and when that removal is complete, like 2 ticks, 4 ticks, etc. And you also have control over the color of these single print zones. So if you wanted blue for upside singles and red for downside singles, that's the default setting in the study. But the idea behind single prints is essentially, most markets don't go directionally up or down, straight up or down, but sometimes they do. And single prints help us provide some context around what's happening with the market in the terms of, a trend. And so all trend days, or most trend days, are going to have single prints. And I did a lot of work around single prints recently, putting out some stats on that. So if you haven't read about the, some of the findings that I came out with, with single prints and how I'm leveraging those, I would encourage you to go visit the Offsides and Tilted channel in Discord. And there's a nice write-up there, or on my Twitter feed. The same write-up also exists there. So here's an example of the TPO. So what that would look like on a TPO chart. As you can see, you have F singles here, as well as G singles. So you have 2 sets of singles in this example. And the nice thing is that AutoPlot has flexibility to where if you want to put them on a TPO chart, you can. If you want to put them on your execution chart, you can. Or if you want to put them on any other time frame chart, you can do that as well. So the next is the RTH gap. This is very simple in concept, but just for clarification, this is when the RTH open is completely outside of, either above or below, yesterday's range. So we're looking at a complete gap and trading, not comparing cash close to the open, but the full trading range of the prior day. I'm sure you guys have great strategies on RTH gaps. I'm not going to go into, some of the obvious gap and go or, gap fills and all that good stuff. But this is just automatically plotting it for you, so you don't have to. And then, as you can see, it auto adjusts the zones, so you don't have to track that either. Poor high and poor low. This is when the high or low of a 30-minute period has the same or equal high of a prior period. That's also the high or low of the day. So there's a couple examples here on the chart, but what you can gain from knowing about a poor high or poor low is essentially there are weak reference points in the auction, and there's mechanical in these examples, some mechanical selling, but really what's happening is that you have buyer exhaustion into these areas. Traditionally, you would say, a lot of traders would say, well, a poor high or a poor low is going to get repaired. And that's true. They usually are revisited as they're seen as an incomplete auction. But, we don't get to pick when that happens. Personally, I view them in real time as exhaustion. And so I will take trades against a poor reference and, to the other direction. Whereas I know, traditionally some market profile folks may try to trade into that poor reference to quote unquote clean it up. I see it as a little bit of a different strategy in the sense that, if we have exhausted buyers at highs, it's going to take a lot more effort on their part to go clean those up. So they're good to be mapped out later, and they're also great to give you context. So recently, and the down, a couple of down moves in this auction here, we've been making poor highs as we've been going lower. And so what that's telling me is that the market is getting exhausted into, highs and having to auction lower to find new buyers and entice new buyers to bring the market back up. So that's also something to note, because it gives you context that, the buying in this area is incredibly strong. And you can see that, over multiple time frame, multiple day span. So the nice thing here is it's automatically done for you. This can, again, be plotted on a TPO chart. It can be plotted on a 30-minute chart or even on an execution chart. So you can be aware of it as soon as it happens, or you can have those on your higher time frame charts for a reference later. All right. So this is probably the most exciting part. We've made some major updates to the balance areas. So we're going to dive in a little bit deeper here. So in auction market theory, when it comes to balance, I'm sure you've seen a reference like this many times before. So it's not, anything particularly new necessarily, but just to review, markets tend to go from a balance that create a balance distribution to an imbalance, and then back to a balance, distribution. And so what our goal with the balance area study is to automate the process of finding those balance areas and then giving you reference points for when we are potentially going for, a balance breakout to imbalance, and then locating that balance area again once we get back into a balance trading. So again, this is just gaining insight into, the market's natural consolidation areas. The nice thing here is that we're using predetermined rules. This removes subjectivity, so removes your bias or anything. So we are always looking for the same thing at all times. And there is no, well, I think this is balance, I think that's balance. These are hard-coded rules, and we're going to go through those rules tonight so you understand what they are. So what this does is basically gives you an idea of where those higher time frame support or resistance areas are, but also gives you context of, hey, when's a legitimate breakout happening versus, potentially a fake breakout. And, it's automatically mapped for you. And again, can be put on any chart. So TPO, 30-minute execution. Typically, I like to use this on my higher time frame 30-minute charts. So this is a nice, clean way to get that visual reference of when we're in balance and when we're potentially leaving the balance area. So what are the balance area rules? And this is a new update that was just pushed today for Sierra chart and will be pushed to NinjaTrader as well as Motive Wave in the coming days or weeks. We will keep you informed on when that happens, but I don't imagine it will be long because they've been working on it already. So how do we start a balance area? There's two essential rules. One of them is we've moved from 2 days of overlapping value to 3. So in this example below, we can see we have 1, 2, and 3 on this chart at the bottom. And so we have 3 days of overlapping value. And important to note that day 3 is always compared to day 1, in the sense that we can't have sequentially lower value or sequentially higher value that still overlaps. We've eliminated those sequences such that when you're trending up and you still have overlap, kind of like you see here where this gap, these moves here. So we're ignoring these because, this day didn't overlap. So this is put some restriction on, the balance area such that it's more selective. It's looking for more rules to, create that balance area to start with. In addition to that, we have also introduced an overlap percentage, and that overlap percentage is just enough to where, day 3, if it's just like 2 ticks within that day 1 value, it's going to get ignored. And that's just to eliminate, some of those days where and that's, the majority of volume. So we consider, volume as acceptance, and that value is the highest area of that acceptance. And so there are days when value from prior sessions overlap, but it's just not enough to really make sense to include it as a balance area or to expand that balance area. So those are the two big changes to start a balance area. So we have 3 days of overlapping value, and then the overlap percentage, which is hard coded so that we're all looking at the same thing day in and day out. So when does balance expand? Again, same rules as the current balance area, just with a small tweak, in the sense that if we have an established balance area, that balance area is going to have a value area built in. And in the study, you can map out the balance area high and low from the price high and low of the balance area based on the bar, or you can map out the value area of that balance area. So you have two options for drawing that. So to expand the value area, we have to have a day with overlapping value from that day compared to that balance area's value. So basically, you have to have a session that expands price, higher or lower, but the value is still inside of that balance area's value area. It also does have to meet that percentage threshold requirement such that it eliminates some of those spots where, it's just a couple of, it's just a small overlap, but not enough to make sense. So again, similar rules to expand balance that start balance. And I think the updates will make a ton of sense when you throw these on some charts and start looking backwards. So I've just highlighted here in orange examples where the balance area would have expanded. So in this sequence here, 1, 2, 3 would have started this balance area from this high to this low from day 1. And that would have extended through until this day where you have this value area here that definitely met, inside of the value area from balance, and it expanded the value area just a little bit. And what's interesting here in this sequence is that, you get this push above this balance area, and then basically you get a traversal all the way back through to the other side of value or the other side of balance. And then you extend balance a little bit lower on this day because you have that overlapping value again. Here in this day, it's totally ignored because the value area here doesn't overlap. So this is looked at a peak and fail potential. And then here in this day, we have another expanded because this value then overlaps the combined value area from all of these sessions. So we do expand the balance area based on those value area days where the value area is inside of the established balance area. So how do we trade this is, you're looking for the top of balance to be resistance, right? That's pretty straightforward. And then the bottom of balance to be resistance as well. You also want to look for patterns of failed breakouts or breakdowns. Typically in a bullish environment, we would say that the most likely scenario in a bullish market for a breakdown is to look for a failed breakdown and then a traversal back through value or back through balance and then up. But you can definitely have a failed breakout that comes back in and trades through the other side of balance. That can happen across the balance area several times. Just like, in this picture, you'll get a balance area that's established. You'll test the upper side of it. You'll test the lower side of it. You maybe go for a breakout in one direction and then come back in and then go all the way to the other side. So the balance area itself, we're looking for, that's kind of where the edges of, the market are in general. So support and resistance potentially. And then also this gives you a very clear area to understand where break from balance could happen. And when we're starting to trade above certain areas, is that meaningful or not? So the balance breakouts, it looks exactly like this picture does. And obviously we have the benefit of hindsight, of course. But what do we look for as potential clues that we're going to leave an established balance area? One of them would be a gap, as you see in this picture. The other would be trend days that have single prints that get us into a breakout. Or we could also have market events that take us into a breakout so that, you have an established balance area, you're trading, and then you have some type of market event that breaks you out of that balance area. And we go test, higher for, go into price discovery mode. And those days are often going to have single prints as well. So here's an example of a failed breakdown that we leave a balance area intact until we've established a new balance area. And that's also another change in the rules. This really helps you keep in context what's been happening in the market and how we got to where we are. And what I mean by that is previously with the balance area study, if we left a balance area for more than 2 days, because we had the peak and fail sequence, if we left the balance area for more than 2 days, we would clip that balance area and not draw another balance area until balance was reestablished. So it's different in the sense that we've changed the rules there, but what's happening is we're going to continue to draw that balance area that we had formed and left until we've established a new balance area. And this helps you keep into context where we came from when we do break out, and then also help you understand, hey, if we leave balance and we come back into that balance area, what's likely to happen? And that's what I'm trying to illustrate in this image below, is that we have this established balance area. It does, experience a breakdown, and that breakdown never establishes value lower for long enough that it gets accepted. And so then all of a sudden we're back in this balance area through, we establish back inside of it and test the lower part again, and then ultimately, goes through to the other side. Now, these are multi-day sequences clearly, but this is the, visual reference that I'm talking about on a higher time frame that helps you, keep your orientation straight with where we're going. And so then here we have, a new balance is formed from this pattern here. And so that's why we now leave the balance area on the chart until we establish a new balance area. And now that we've established that new balance area, the old balance area is then clipped or removed based on your settings, and we're good to go there. All right, so leg-to-leg profiles have been pretty popular, especially since the last webinar that we covered the leg-to-leg delta profiles. But I wanted to go ahead and cover, just a summary on those again, plus, some of the other uses. So we have the delta leg to leg, the volume profile leg to leg, and then new is the anchored balance area start. We'll cover that in just a moment. So leg to leg for delta is just creating a delta, using a delta profile, mapping leg to leg to the delta profile. And this allows you to see that real-time absorption. If you want to get more insight into that, I would invite you to go watch that webinar. It was the Liquidity Zones Deep Dive webinar. And, just as a reminder or review, this really helps spot that real-time absorption. You're looking for area of consolidation. Think it's a process. It's not an event where you're looking at very high amounts of delta, so either negative or positive delta, in a miniature balance area so that, price is not really going anywhere, but there's tons of negative or positive delta being built up at a high or a low. So you're looking for rejection activity, a tight range, buildup of delta, and potential entry against that real-time absorption would be what you would be looking for. And again, this takes time. It's not an event-based sequence like an exhaustive move would be. Leg to leg using volume profile. So this is more of a traditional sense of leg to leg. This is something that Job introduced, his idea maybe a couple of years ago, and just taking a volume profile, identifying a swing point in the market, and then drawing that volume profile from that swing point. This helps you spot, HVNs, LVNs, see taper and exhaustion. You can see potential areas of support and resistance, and it helps with risk management as you're managing a trade in a leg in a current move. So the anchor point you can see, that's controlled by the leg to leg profile, which is controlled by the settings, and that automatically, readjusts from each swing point in the market. All right, so the next is the leg to leg balance area anchored. So basically this is a new feature that's coming ASAP. I'm testing it right now. But essentially what it does is it takes leg to leg, and then, we just talked about how we establish a balance area and how all of that stuff works. This is going to attach the start of a volume profile to the start of a balance area. So this allows you to track, those HVN, those LVNs, and, value inside of a balance area. And this is actually going to be my higher time frame look. So essentially I have a volume profile instead of a rolling 5 or 7 day. I'll essentially be moving to this anchored to balance area method, such that when we're in balance area, when we're in balance, I'll have that volume profile. That profile is going to build out even as we break out of balance. So I'll be able to reference those LVNs and such as we leave balance. And then once we reestablish balance, guess what? I'll have the volume profile will reset to that new balance area start. So again, this is a really nice update that was actually pretty easy to implement. I'm just testing a few things before we push it out there. So we'll get that out here in a couple of days on Sierra, and then Ninja and Motivwave to follow. Any questions before we dive into MGI. I'm going to pause just a moment, catch my breath, and see if you guys have any questions. Job is on the stage. Good evening, Job.
Hey, Leo. Hey, so just maybe a little bit more transparency so that everybody understands, like instead of utilizing the rolling volume profile, when we do leave balance, until we signal that next balance, we're seeing continuation of that profile. That way everybody's clear on that.
Exactly.
Perfect.
J. Rob says, do the 3 days need to be consecutive? 3 days of overlapping value. Yes, they would need to be consecutive. Go back to this here. So we have day 1, day 2, day 3. All of these days need to overlap each other, and day 3 has to overlap 1, especially by the overlap percentage requirement. Looks like somebody's typing here. Will the new balance area appear upon chart reload? For Sierra chart, you just restart Sierra chart and the new balance areas will automatically appear. They've been pushed out already. So there's nothing you need to do to get to capture the new rules with the algorithm. You bet. All right, I'm going to assume that you guys are all experts in balance areas, single prints, poor highs and lows, and such. Leg to leg volume profile. This is, for me, it's a big time game changer. Just having that established to that balance area start. It's a more defined process for me. I see Brian's starting to type a question, so keep going. I'm going to just drill through the MGI real quick because that's the most basic. So there's 3 types of MGI. We have daily, weekly, and monthly. Pretty self-explanatory of what MGI is. It is market-generated information. So these are highs and lows, value areas, VWAP, opening ranges, opens, closes, and this happens on all 3 time frames, right? Your daily, and that daily is broken out by RTH and Globex. We have our weekly, and then we have our monthly time frame. So for reference, the glossary of available automated MGI that's in the study itself are, here in the daily MGI. Obviously, nobody should be using all of these, but we intentionally put, as much as we, could think somebody would want to give you those reference points if you want to draw them. Personally, I use prior day high low, prior day close, the opening range, and the opening range mid, prior day mid, and overnight high and overnight low. And then I map the IB high and IB low just as text on the right side of my screen. I also have the VWAP. So I just use a few of them. Those examples are in the OFL chart book. For weekly MGI, it's the same concept. Obviously, there's less information on a weekly time frame. So we just have prior week high, low, close, the value area, POC, prior week open, the current week open, which I famously dubbed the G line. So if you see that on any of my charts, just remember it is current week open. Very significant point of reference, and provides great opportunities for, as a support and resistance area. I know many of you have included that in your daily stuff. And then we have the monthly time frame. So monthly high, low, close, VWAP, value area, etc. And all these automatically reset. So at each RTH close, the daily MGI is automatically updated. You can hide the old levels if you don't want to see them when you look left. Same thing on the weekly time frame. It resets every Friday. And then on the monthly time frame, it will reset at the monthly close. All right, so the new thing we just added to MGI is proximity. This is a considerably sped up video. So the levels, flashing on and off would definitely not happen when you had, the appropriate settings. But essentially, what this does is it puts into rule to where you put in a proximity range, and we automate the process of hiding and showing those lines based upon if we are within that proximity range or not. And what this allows you to do is take, for example, like your monthly MGI, which you don't, we don't interact with it a ton. And so maybe you don't want to see it all of the time on your execution chart or other chart. And so you would use proximity and say, okay, well, when we're within 40 points or, 10 points or, some value that is important to you, then show me the line. Otherwise, I don't want to see it. So hide it. And that was the whole idea behind proximity. So that's available on all three time frames. So it's daily, weekly, and monthly. So you have the ability to, control that. There's also a setting in there that puts a time requirement. And so that way, if we're kind of flirting with the edge of that proximity, you don't have any flashing of the line necessarily. So let's say, for example, I use 30 seconds on my stuff. And that is kind of a balance between, what's the level, like how often, are we going to interact with it? How close is that proximity? And so you would want to adjust your time second interval based on those things, right? And what I mean by that is, if you've got something that's within a 10-point range and, a 20-second qualifier, well, in NQ, we can travel 20 seconds and 10 points in 20 seconds easily. So you might miss that level may, flash, and we've already traded there. We're already there. You might do a shorter time frame there, like 5 seconds. And then conversely, you might do something longer for, something that's far away. So that's a good frame of reference there. Brian says, I'm not showing prices for prior balance areas. Brian, just open a ticket and we'll get you squared away there. It may be just an update for the study itself or study settings. Okay. If nobody has any further questions,